It is the announcement that every single homeowner in Canada has been praying against for 6 months. It is the moment where the last flicker of hope for the spring market of 2026 was officially extinguished. Yesterday morning at 10 a.m., the Bank of Canada did not just hold interest rates, they held a funeral for the Canadian middle class. Tiff Macklem walked up to the podium in Ottawa, and instead of offering the lifeline that the real estate industry had practically promised you, he delivered a death sentence. The Bank of Canada has held its key interest rate steady at 2.25%. There is no cut. There is no relief. But the number isn't the story. The story is what he said afterward. In a moment of terrifying candor that we rarely see from central bankers, Mark Tiff Macklem looked into the camera and effectively admitted that the Canadian economic model is broken. He stated in no uncertain terms that monetary policy cannot fix the structural damage we are facing, and that the era of open, rules-based trade with the United States is over. Let that sink in. It is over. The trading relationship that accounts for nearly 80% of our exports, the relationship that underpins our entire standard of living, the relationship that keeps our dollar from becoming the peso of the North, it is dead. And with it, the hope that the Canadian housing market can simply bounce back has evaporated. Welcome back to Canada Property Watch. Today, we are not just talking about interest rates, we are talking about the end of an era. We are breaking down the catastrophic decision by the Bank of Canada to hold rates, why they had no choice, and what Tiff Macklem's admission, combined with the shocking Rupture speech from Prime Minister Mark Carney, means for the value of your home, the safety of your job, and the future of your money in this country. If you thought the great devaluation was bad, you have not seen anything yet. The isolation of the Canadian economy has begun. To understand why this rate hold is such a disaster, we have to strip away the noise and look at the expectations. The narrative sold to you by the mainstream media and the real estate industry was simple. Survive until 2026. They told you that by now, inflation would be crushed, the economy would be soft, and the Bank of Canada would slash rates back down to neutral to save the housing market. Just hold on, they said. The cavalry is coming. Well, the cavalry didn't show up. By holding rates at 2.25%, the Bank of Canada has effectively trapped millions of borrowers in a higher for longer nightmare. Remember, 2.25% is the overnight rate. That means prime rates at the big banks remain punishingly high. It means variable rate holders are not seeing their payments drop. It means the bond yields that drive fixed mortgage rates are not going to collapse. But why? Why didn't they cut? The answer lies in the second part of the bombshell, the United States. We are witnessing the weaponization of the US dollar and US trade policy under the new protectionist regime south of the border. With new tariffs of 10 to 25% looming over Canadian goods, inflation in the US is ticking up. The Federal Reserve is holding their rates high to fight it. If Canada cuts rates while the US holds, the spread between our currencies widens and the Canadian dollar crashes. It's that simple. Tiff Macklem had to choose between destroying the housing market or destroying the currency. He chose the housing market. By holding rates, he is trying to defend the Canadian dollar from falling to 60 cents. But the cost of that defense is your mortgage. The cost is the solvency of the Canadian consumer. This is the rock and a hard place scenario we have warned you about for 2 years. And now, the rock is crushing us. Let's dig deeper into the political earthquake that accompanied this financial one. We have a new Prime Minister, Mark Carney, who just delivered a speech at the World Economic Forum in Davos that can only be described as a eulogy for the global order. He used the word rupture. He told the world that the international rules-based order is collapsing and that middle powers like Canada can no longer rely on American benevolence. When the Prime Minister and the Governor of the Central Bank are both telling you that the system is broken, you need to stop listening to your real estate agent who says it's a great time to buy. This rupture is not theoretical. It is hitting the ground right now in the form of a sectoral collapse. Let's walk through the specific industries that are being decimated, because real estate values are ultimately derived from the income of the people living in the houses. If the jobs go, the mortgages default. When it is that simple. First, Look at the forestry sector in British Columbia and Quebec. This is no longer a cyclical downturn, it is a structural failure. We are seeing US tariffs of up to 25% on softwood lumber. This has effectively closed the border to Canadian wood. Mills are shutting down permanently. These are not temporary layoffs. The machinery is being auctioned off. Entire towns that rely on these mills are seeing their real estate values go to zero because the only employer in town has left. Now, if you own rental property in a resource town, your vacancy rate is about to hit 100%. Second, the auto sector in Ontario, and this is the heart of the Golden Horseshoes economy. The USMCA, the trade agreement that protected our auto industry, is being renegotiated under threat of massive tariffs on aluminum and steel. The forecast is grim, a projected 8% decline in Ontario's manufacturing GDP in 2026. That is a recession-level contraction. We are talking about tens of thousands of auto workers in Oshawa, Windsor, and Oakville facing layoffs. These are the people who bought those million-dollar suburban homes. If they lose their jobs, they cannot pay their mortgages. And unlike in 2008, they cannot just move to Alberta because the oil patch is under attack too. Third, the energy sector. The new U.S. administration has signaled a 10% tariff on energy imports, including Canadian oil and gas. This is a direct strike on Alberta's economy. The Western alienation is about to turn into Western insolvency. The banks know this. That is why they are increasing their loan loss provisions for the energy sector. They expect defaults. This creates the liquidity trap we discussed in our last video. Sellers need to sell because their renewals are coming up, but buyers won't buy because the future is terrifying. When you have desperate sellers and no buyers, prices don't just slide, they gap down. We are going to see a repricing of risk that will make 2024 look like a picnic. And let's talk about the mortgage renewal wall. It is no longer a future threat. It is here. Every day, thousands of Canadians open their mail to find a renewal letter that doubles their interest costs. They were holding on for this January announcement, when they were praying for a 50 basis point cut to soften the blow. That cut didn't happen. Now, they have to make a decision. Do they cut food? Do they stop paying the credit card? Or do they list the house? Kevin O'Leary warned us this week about the money trap. He said millions of families are trapped in assets they can no longer afford. Tiff Macklem just locked the door to that trap. By refusing to cut, the Bank of Canada is essentially saying that they are willing to sacrifice the homeowner to save the loonie. They are calculating that a wave of foreclosures is better than hyperinflation imported from a collapsing currency. It is a ruthless calculus, but it is the reality of our position as a vassal state to the US economy. We also need to address the white-collar purge that is quietly accelerating in the background. While the blue-collar sectors get hit by tariffs, the white-collar sectors, tech, consulting, financial services, are getting hit by a different wave. AI, automation, and efficiency cuts. The skills gap is widening. Entry-level coding jobs, data entry, basic financial analysis, these roles are vanishing. The young professionals who used to buy downtown Toronto condos are graduating into a market that doesn't need them. This is why the condo rental market is softening. The tenants don't have jobs. The investor graveyard we warned you about is now open for business. The condo market in Toronto is already dead. With this rate hold news, it starts to rot. Investors who were cash flow negative by $1,000 a month were holding on, hoping that lower rates would reduce the bleeding. Now they know the bleeding won't stop. In fact, it might get worse if tenants lose their jobs and stop paying rent. Watch for a massive spike in power of sale listings in the condo sector over the next 60 days. These investors are going to rush for the exits all at once. But there is a darker layer to this story, the bail-in risk. As the economy weakens and loan defaults rise, the bank's balance sheets deteriorate. We know they are already increasing their loan loss provisions. When Tiff Macklem says trade is dead, he is telling the banks that their commercial loans to exporters are in trouble. The banks will respond by tightening credit even further. This is the secret freeze getting colder. They will pull lines of credit. They will reduce credit card limits. They will hoard liquidity. If you are a business owner, this news is catastrophic. You rely on the flow of goods across the border. You rely on credit to bridge your cash flow. Both of those lifelines are being squeezed. We are going to see a wave of business bankruptcies in Q1 and Q2 of 2026 that will rival the 2008 financial crisis. The IMF just issued a red alert warning that Canada's internal trade barriers are choking growth. We are fighting a trade war with the US while still fighting trade wars between our own provinces. It is economic suicide. And what is the government's response? Prime Minister Carney is talking about diversifying trade and building strategic autonomy. That is political speak for we are on our own. You cannot replace the American market overnight. You cannot build pipelines to the coast in a month. We are structurally dependent on a partner who has decided they don't need us anymore. The post-national state is being crushed by the reality of economic nationalism. So, what is the strategy for you, the individual, watching this unfold? First, you must reach a state of acceptance. You must accept that the bailout is not coming. Rates are not going back to zero. The value of your home is not going back to the 2022 peak. In fact, it is likely going much lower. If you are holding an investment property that is bleeding cash, you need to cut the limb to save the body. Sell it. Take the loss. Liquidity is more important than equity right now. Second, you need to play defense. If you have a variable rate mortgage, you are in the danger zone. The spread between Canadian and US rates is the pressure cooker. If the loonie drops too far, the Bank of Canada might actually have to raise rates to defend it. I know that sounds insane, but it has happened before. Do not assume 2.25% is the ceiling. In a currency crisis, the ceiling can disappear. Lock in if you can survive the payment, or sell if you can't. Do not gamble on the central bank pivoting. Third, focus on cash positioning. In a credit freeze environment, cash is king. If the banks stop lending, the only people who can buy assets are those with cash. If you are sitting on cash, you are about to see the buying opportunity of a lifetime, but not yet. Wait for the panic to set in. Wait for the power of sale inventory to flood the market. The time to buy is when there is blood in the streets, and Tiff Macklem just handed the market a knife. Fourth, prioritize job security. This is the most underrated risk. The white-collar purge is accelerating. If your company relies on US clients, you are vulnerable. Tiff Macklem's warning about trade is a warning about your job. Build an emergency fund that can last 12 months, not 3. The job market in 2026 is going to be brutal. We are witnessing the end of the Canadian dream as we knew it. The dream was built on cheap money, endless real estate appreciation, and easy trade with the US. All 3 pillars have collapsed. We are now entering the Canadian reality. It is colder, it is harder, and it requires a completely different mindset to survive. This is not fear-mongering. This is reading the minutes of the meeting. This is listening to the words of the governor himself. It's over. When the man in charge of the money printer tells you the game has changed, you better listen. Do not let the real estate boards gaslight you into buying this spring. Do not let the bank tell you everything is fine. Look at the data, look at the geopolitics, and look at your own balance sheet. I will be breaking down the specific regional impacts of this trade war in the next video, specifically what happens to the Atlantic provinces and the prairies as the internal trade barriers choke off their recovery. The pain will not be evenly distributed. Some regions will become ghost towns. Subscribe to Canada Property Watch. We are the only channel telling you the truth about the collapse of the Canadian economy. The mainstream news is brought to you by the banks and the real estate developers. We are brought to you by reality. Stay safe, stay liquid, and prepare for the storm because the shelter we thought we had just blew away.